$500,000 buys you exactly $1,667 a month in retirement income. That's the math. That's the 4% rule. What the thumbnail doesn't tell you is that the same $500,000, depending on 5 decisions that have nothing to do with your investment returns and nothing to do with the stock market, either outlasts you comfortably or runs dry before your 83rd birthday. And I can show you the difference to the dollar with 2 real people who started at the same place and ended up in completely different financial universes. There are 2 brothers in this story. Frank and Dennis grew up in the same house outside Columbus, Ohio. Both retired in 2015 with just under $500,000. Both had financial advisor's eyes. Both checked every box they were told to check. 10 years later, Frank still has $460,000 invested and spent last spring in Portugal. Dennis has about $90,000 left and is having quiet conversations with his kids about what the plan looks like from here. Dennis was the more careful one his entire career, drove a cheaper car, saved more aggressively per paycheck, did everything right by conventional standards. I'll tell you exactly what happened, but first the framework, because without it, the story doesn't land. William Bennon published the 4% rule in 1994 in the Journal of Financial Planning. He analyzed every 30-year retirement window in market history, going back to 1926. His finding: withdraw 4% of your portfolio in year 1. Adjust that number upward each year for inflation, and your money survives all of them. The Great Depression, stagflation, the dot crash, every ugly period in the dataset. For $500,000, 4% is $20,000 a year, $1,667 a month. The problem is that floor sits below average rent in 48 of the 50 largest American cities as of early 2026. So, what you are actually managing here isn't a nest egg. You are managing a runway. Think about it that way. $500,000 is your runway. The question isn't how long the runway is. The question is how much your plane weighs. A plane loaded with debt, high fixed monthly expenses, early Social Security, no healthcare bridge, expensive zip code. That plane might not get airborne on $500,000 of runway, no matter how disciplined you've been for 30 years. Strip the weight down and the same $500,000 gets you wheels up and climbing. Every decision I'm about to walk through either adds weight to that plane or removes it. That's the only lens that matters. Most retirement content argues about the size of the runway. Today we're talking about the weight of the plane, and there are 5 dials that control it. In a few minutes, I'm going to show you the single most valuable timing decision available to an average American retiree. It's worth more lifetime money than almost any investment choice you could make, and most people handle it in 20 minutes without ever calculating what it's actually worth. But first, let me start with the dial that most people think is their biggest problem. It's not, but if you ignore it, it will quietly destroy everything else. Healthcare. If you're 65 and enrolled in Medicare, you're protected. Not comfortable? Protected. Medicare Part B, which covers outpatient care and doctor visits, costs $185 a month per person in 2025. Add a Part D prescription drug plan. Add a Medicap supplemental policy to cover what standard Medicare doesn't pay. You're realistically spending $400 to $600 a month per person in premiums alone, for a couple $800 to $1,200 a month before any co-pays, before any procedures, before anything goes wrong. Fidelity's 2024 retiree healthcare cost estimate puts average lifetime healthcare costs for a 65-year-old couple at $330,000. $330,000. That is 66% of your entire $500 portfolio allocated to one expense category. That is not a catastrophic scenario. That is the median. But the real danger zone is what happens before 65 if you want to retire early. If you retire at 60, Medicare isn't available. You're buying insurance on the ACA marketplace. A 60-year-old purchasing an unsubsidized silver plan in 2025 pays over $1,000 a month in most states. In some states, considerably more. Now run the math. If your portfolio income is $1,667 a month and healthcare takes $1,200, you have $467 left for housing, groceries, utilities, transportation, and everything else. You haven't retired. You've reclassified your financial stress. and started draining your principal at the worst possible time. There is a specific tool that solves the 5-year danger zone, and most people don't discover it until it's too late to fully use it. The health savings account. If your employer offers a high-deductible health plan, you can contribute $4,300 as an individual or $8,550 for a family to an HSA in 2025. Pre-tax money going in tax-free growth inside tax-free withdrawals for qualified medical expenses. That is a triple tax advantage. There is no other account structure in the entire United States tax code that gives you that zero. I know a corporate attorney in Dallas who maxed her HSA for 12 consecutive years while paying small medical expenses out of pocket to let the account compound. She retired at 63 with $68,000 sitting in that account. Her 5-year healthcare bridge, 63 to 65, cost her almost nothing from her investment portfolio. She was flying light because she'd been pulling weight off the plane for over a decade. People who don't know about this in time spend over $1,000 a month on marketplace premiums for 5 years. That's 60 plus 000. Not just removed from the portfolio, but removed at exactly the period when sequence of returns risk is highest, which is the first years right after you retire. You're not just losing the premiums, you're losing the compounding on the premiums during the window when every dollar you preserve matters most. The plane was heavier at the worst possible moment, and nobody told you it was happening. Now, here is where it gets really interesting, because there's one dial that is worth more money than any other single decision in this entire conversation. It is the most financially consequential choice most retirees make, and most of them make it in about 20 minutes without running a single calculation on what it's actually worth in lifetime dollars. Social Security. Here's how most people handle it. They go to saa.gov, look at the number and file when they feel ready to stop working. Maybe they do the break-even math, calculate the age where delaying pays off, decide it's not worth the wait, and move on. This is a mistake that, depending on your benefit level, costs you over $200,000 in guaranteed lifetime income. Here is the actual mechanic. If you were born after 1960, your full retirement age is 67. File at 62, the earliest you're allowed, and your benefit is permanently reduced by 30%. Not for a period of time, for every single check you receive for the rest of your life. Wait until 70, and your benefit grows by 8% per year for each year you delay past 67. That 8% is guaranteed, it's inflation adjusted. It is backed by the federal government. You cannot buy an annuity with those terms anywhere in the private market, not at any price. Numbers. Assume your full retirement age benefit at 67 would be $2,000 a month. File at 62, you receive $1,400. File at 70, you receive $2,480. That's a difference of $1,080 every single month for the rest of your life, adjusted upward each year for inflation. From age 70 to the average life expectancy of approximately 88 for someone currently age 65, that's $233,280 in additional lifetime income. Same program, same contributions you already made. Die. Fair and timing decision. The standard counterargument, what if I die before the break-even age? I'll have left money on the table. That logic treats Social Security like a bank account you're trying to maximize at death. It's not. It's a guaranteed lifetime income stream whose value compounds in ways the break-even math doesn't capture. A higher monthly Social Security benefit means you pull less from your invested portfolio every month, which reduces your exposure to sequence of returns risk. And for married couples, the higher earner's benefit becomes the survivor benefit. Delaying can mean decades of higher income for a surviving spouse who lives into their 90s. The break-even math misses all of that. The strategic move: use your $500,000 as a bridge. 3 years of living expenses, $9 to $120,000, to buy yourself a $200 plus, 0 guaranteed income increase for life. That might be the best risk-adjusted trade in personal finance for the average American retiree. The runway doesn't shrink. The government fills part of the fuel tank. One more thing on this, and it's worth knowing. The financial advisor sitting across from you, earns their fee as a percentage of your assets under management. A larger Social Security benefit means you pull less from the account they're managing. Less for them, not malicious. Incentives doing what incentives do. Worth knowing before you take that advice. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. This is a good moment to check back in on Dennis, because this is where his story starts to make complete sense. Dennis retired in 2015 in the San Francisco Bay Area. His kids were there. His whole life was there. He sold his Ohio house and rented an apartment in the East Bay for $3,400 a month, planning to figure out whether to buy something later. He filed for Social Security at 62 because he needed the income and because a columnist he respected had convinced him the break-even math didn't favor waiting. He received $1,150 a month. Total monthly income $1,150 from Social Security, $1,667 from his portfolio, $2,817. Monthly expenses $3,400 in rent, food, insurance, utilities, transportation. Roughly $5,800 total. Every single month, Dennis was $3,000 underwater. He was pulling from principal. The runway was shortening by design from his first day of retirement. Dennis wasn't spending on luxuries. No car payment. Didn't travel. He was in the wrong city at the wrong cost structure, with a permanently discounted Social Security benefit and no health care plan for the 3 years before Medicare. The plane was heavy before it ever left the gate. Let me make this concrete with one real scenario. Patricia is 63, retiring next year with $500,000 in a 60-40th split, 60% S&P 500 index fund, 40% intermediate bond fund. Her Social Security statement shows a full retirement age benefit of $1,900 at 67. She currently rents in Austin for $1,800 a month. No other debt. $40,000 in an HSA built over 12 years of contributions, and a standing offer from her former employer for part-time consulting work. Here's the plan. She retires, but doesn't file for Social Security and doesn't touch her investment portfolio. She takes the part-time consulting 15 to 20 hours a week, and it covers her living costs. HSA handles any medical expenses for the 2 years before Medicare. At 65, Medicare starts. She relocates from Austin to a mid-sized college town in North Carolina, where equivalent housing runs $900 a month instead of $1,800. Her monthly expenses drop to around $2,200. Medicare plus a supplement plan runs about $450 of that. At 67, she files for Social Security at her full retirement age, $1,900 a month. She adds about $700 a month from her portfolio, a withdrawal rate under 2% on H. Her starting balance, total monthly income, $2,600. Monthly expenses, $2,200. Monthly surplus, $400. Here's what happened to her $500,000 while she wasn't touching it. 4 years of compounding before she pulled a dollar. Then for the next 13 years, she withdrew from it at a rate well below its growth rate. By age 80, with historical average returns on a balanced 60-40ths portfolio, Patricia's account has grown to well over $1 million, not because she got exceptional returns, because she barely needed to touch it. She started with $500,000. She ends with more than double that. The plane was light. The same runway was more than enough. Here is something I want to say plainly about the choice most people think of as the cautious one. Keeping retirement savings in a savings account to avoid volatility isn't safe. It is erosion wearing a conservative suit. In early 2026, inflation is running around 2.5% annually. At 2.5%, your purchasing power halves in roughly 28 years. The $1,667 you withdraw today feels like $834 in 2015. Groceries, utilities, insurance, healthcare. None of it stays flat. The money is losing real value whether you're watching the market or not. A savings account earning 2% while inflation runs at 1.5% loses 0.5% of real purchasing power every year compounded over 25 years on $500,000. That's roughly $55,000 in real value erased. Even if the nominal balance looks stable on the statement, You didn't make a bad trade. You made no trade and got quietly punished for it anyway. The S&P 500 has returned an average of roughly 10% annually since 1926 before inflation adjustment. In a balanced 6,040 portfolio of broad equity index funds and intermediate bond, the historical real return after accounting for inflation has been closer to 5 to 6%. That's what keeps the runway from shrinking over a 30-year retirement. And the data on active management is not ambiguous. SPIBA's annual scorecard consistently shows that over 15 years, roughly 88% of actively managed U.S. equity funds underperform their benchmark index. 88%. These are full-time professionals paid to do nothing but pick stocks. They can't beat a machine that buys everything and sells nothing. The implication for your $500,000. The laziest possible approach. Low-cost broad index fund investing has a better documented track record than almost everything you'd be paying for. The people who panic sold in 2020, too, when the S&P 500 fell roughly 19% on the year and moved to cash locked in those losses. The market recovered the majority of that by mid-2023. The sellers missed the recovery entirely. The people who did nothing participated in it. Inertia in that case was the strategy. I'll put you in something with steady dividends, the advisor said. Low volatility, safe. What's the expense ratio? Asked the client. There was a long pause. Competitively priced, said the advisor. The client moved everything to a Vanguard index fund charging 0.03%, 0.03%, and stopped taking the calls. The advisor charged the next guy 1.5%. The next guy thought that was just how it worked. Stay with me, because this next part changes everything. Where you live in retirement is a financial decision, not merely a lifestyle preference, one of the most significant financial variables in your entire plan. And most people never treat it that way because nobody frames it that way. The Council for Community and Economic Research publishes cost of living indices for American cities. $1 in San Francisco has the purchasing power of about 40 cents in Knoxville, Tennessee. That's not an estimate. That's the measured index for overall consumer prices. Housing, groceries, transportation, utilities. None of it prices uniformly. And the critical shift that happens at retirement is that you are no longer tethered to your employer's city. You can buy the same lifestyle at a 40, 50, even 60% discount by choosing where to buy it. Most people don't because nobody told them to run the number. At 4% from $500,000 plus a $2,000 Social Security benefit, your monthly income is roughly $3,600. In Seattle, a modest, comfortable retirement lifestyle runs about $5,800 a month. You're short by $2,200 every month. In Asheville, North Carolina, that same lifestyle costs around $3,200. You're positive. In Chattanooga, Tennessee, under $3,000 a month, same portfolio, same Social Security benefit, different zip code. The math of the world around you changed. You didn't earn more. You bought the same life at a discount. And for those open to it, the international version of this is even stronger. Portugal's Algarve region, coastal Mexico, parts of Southeast Asia, large established American retiree communities, comfortable quality of life, $2,000 to $3,000 a month in total spending. Not roughing it, not downgrading, flying with favorable headwinds in places where the dollar is still strong. I spoke with a retired electrician outside Boston, 64 years old, kept insisting he couldn't retire. He had $450,000 in his 401k, Social Security coming, and a paid-off house north of the city worth $720,000. I asked what an equivalent house in western North Carolina would cost, where his college roommate had been inviting him for 3 years. He looked it up while we talked. $280,000. He could sell the Massachusetts house, buy the Carolina house outright, in cash, and add $440,000 to his investment portfolio. His retirement savings would go from $450,000 to $890,000 from one transaction. He retired 8 months later. He didn't find more money. He found where the weight was. And once the math was in front of him, the decision took about a week. You think the problem is the size of your portfolio. The actual problem is that nobody has ever made you calculate the cost of staying where you are. Once you see that number, the answer usually gets a lot clearer. So, you're telling me to move to Tennessee. I'm telling you to know what Tennessee costs. That's the same thing. No, one's advice, the other's arithmetic. But here is what nobody is telling you about the final piece, and this is where the most pushback comes from. Usually from people who are already committed to the argument they heard somewhere: debt at retirement. The counterargument: if your mortgage rate is 3 or 4%, and the market historically returns 10%, you should mathematically keep the mortgage and invest the difference. On a spreadsheet under frictionless ideal conditions, this is approximately correct. In the real world, it breaks down in a specific and predictable way. A mortgage payment cannot be paused. It is a fixed mandatory monthly obligation that exists regardless of what the S&P 500 is doing, which means in a year when the market is down 20%. And this happens on average once or twice per decade. You are a forced seller every single month. You are liquidating invested assets at a loss to service a debt that does not respond to market conditions. You are compounding sequence of returns risk at exactly the moment it does the most damage. The spreadsheet doesn't model forced liquidation during a down market. The spreadsheet assumes you can hold. In real life, the mortgage doesn't care about your conviction. Vanguard's research on this is clear. Retirees without mortgage debt show statistically lower portfolio withdrawal rates, better portfolio survival outcomes, and meaningfully lower financial stress indicators than retirees with equivalent portfolios carrying mortgage debt. The explanation isn't the interest rate arithmetic. It's the behavioral and mechanical effect of having a lower minimum monthly burn, and therefore a lower mandatory withdrawal rate in the years when not selling is the whole strategy. If your mortgage is paid off, your minimum monthly spend is food, utilities, insurance, transportation. That plane is light. It can sit on the runway and wait out a bad market year without losing altitude. If you carry a $1,000 monthly mortgage payment, your burn has a mandatory floor that doesn't negotiate with market conditions. Dennis had no mortgage. Remember, he'd sold his Ohio house, but he'd created the same problem with $3,400 a month in Bay Area rent. Different name on the back, same weight on the plane. In 2023, Dennis finally did what he should have done 8 years earlier. He sold his Bay Area apartment, moved to Tucson, bought a modest house outright. With the remaining cash, brought his monthly expenses under $2,800. His Social Security, permanently reduced because he filed at 62, covers most of it. The portfolio, now sitting at $90,000, stopped bleeding. He stabilized. Not thriving, stable. He tells his kids now, every dollar I saved over 35 years got eaten by 3 specific decisions. A city I couldn't afford on my income. A Social Security benefit I discounted in 20 minutes, without running the math, and 5 years of healthcare costs I never built a plan for. The portfolio was fine. The plane was too heavy. I tried to take off on a runway that wasn't long enough for what I was carrying, and I never noticed until the fuel was mostly gone. Frank didn't retire with a better portfolio. Frank moved to North Carolina, delayed Social Security. To 68, used 3 years of portfolio income as a healthcare and income bridge, and never once built a monthly expense structure his income couldn't cover. Same runway, much lighter plane. 10 years later, the difference is $370,000 and widening. 3 things this week, not eventually this week. First, go to sasa.gov, create an account and look up why. Our projected Social Security benefit at 62, 67, and 70. Write down all 3 numbers. Then calculate the monthly difference between filing at 62 and filing at 70. Multiply that monthly gap by 216. That's 18 years of expected payments from age 70 to 80. That single number tells you what your timing decision is financially worth. Most people make it without ever knowing. Now you will. Second, price out your current lifestyle in 3 cities less expensive than where you live. Don't commit to anything. Don't tell your spouse yet. Calculate. Find your monthly expense number in each city. Compare it to your projected retirement income and see whether the gap closes or disappears. The difference between I can't retire for 5 more years and I can retire in 18 months is often hidden inside a geographic comparison that nobody prompted you to run. Run it. Third, check whether your current employer health plan is HSA eligible right now. If it is, Maximize the contribution for the rest of this calendar year and every year between now and retirement. Every fully funded HSA year is 1 year of healthcare costs that won't touch your investment portfolio during the highest risk window of your retirement, which is the first 5 years. That's not a minor optimization. That is removing weight from the plane before you need the runway. These moves are not exciting. There is no version of any of this that works as a thumbnail. The difference between Frank's outcome and Dennis's outcome, $460,000 still invested at 75 versus 90,000, nearly depleted at 73, was not market timing, not stock selection, not luck. It was 3 dials set to different positions. The runway was the same, the weight wasn't. Lazy investing built more fortune than crypto memes. And if you're still waiting for a more complicated answer, the industry will provide one happily. That is their business model. Making the simply answer look inadequate, so you need their help. The simple answer works. The playing doesn't need to be complicated. It needs to be light.